You're going to hate hearing this, but the single biggest reason you're not profitable yet has nothing to do with your strategy, your indicators, or your market knowledge. It's simpler than that. You're trading too much. And I can prove it to you, with math so clean, so brutal, that once you see it, you'll never look at your trading the same way again. Most traders think activity equals progress. They believe that the more trades they take, the more opportunities they capture, the faster they'll grow their account. It feels right. It feels productive. You're in the market, you're engaged, you're grinding. But here's the truth. Every time you enter a trade, you're not just risking capital, you're paying a tax. And that tax is compounding against you in ways you haven't calculated. The professional trader sitting across from you in this zero-sum game isn't trying to trade more than you. He's trying to trade less. And he's taking your money while you're busy being active. Let's talk about what overtrading actually costs you, because most traders only see the obvious expense. They see commissions, they see spreads, they see slippage. But that's just the surface. The real cost is hidden in 3 layers. And together, they form a death spiral that quietly drains accounts while traders blame their strategy. First, there's the mathematical cost. Every trade you take has a built-in negative expectancy from transaction costs. If you're paying a $2 round-trip commission and trading with a $100 risk, that's a 2% haircut on every single trade before you even see if price moves in your direction. Take 50 trades a month, and you've bled out 10% of your risk capital just to play the game. That's not a strategy problem. That's a volume problem. Second, there's the statistical cost. And this is where it gets nasty. Every trade you take is a sample from your edge's probability distribution. If your system has a 60% win rate with a 1 to 1.5 reward to risk ratio, that's a legitimate edge. Your expectancy per trade is 0.3 R. Sounds good. But here's the trap. That 60% win rate is realized over a large sample under correct conditions. When you take 40 trades a month instead of 10, you're not quadrupling your edge, you're diluting it. You're taking lower quality setups. You're forcing trades that don't meet your criteria because you've been flat for 3 hours and you're bored. You're entering during choppy conditions because you need to feel involved. Your actual win rate on those extra 30 trades isn't 60%, it's 40%, maybe lower. And now your expectancy isn't 0.3 R, it's negative 0.1 R. You've flipped from profitable to losing, not because your strategy stopped working, but because you couldn't sit still. Third, and this is the one that destroys more traders than anything else, there's the psychological cost. Every trade you take is a cognitive load. It demands attention, emotional regulation, decision-making, stamina. When you're in 10 trades a day, you're making hundreds of micro-decisions. Entry, stop adjustment, partial profit, hold or fold, re-entry, revenge trade, fear-based exit. Your brain is a muscle, and you're gassing it out. By trade 7, your discipline is cooked. By trade 10, you're running on autopilot and emotion. That's when you break your rules. That's when you move your stop. That's when you double down on a loser because you're frustrated. The trader who took 2 high-quality setups that day is sharp, patient, and still has the mental bandwidth to manage his risk perfectly. You're exhausted and bleeding. Here's the math that will change how you think about this forever. Let's say you have a system with a genuine edge. 60% win rate, 1.5 to 1 reward to risk. Your expectancy is 0.3 R per trade. Beautiful. Now, let's compare 2 traders. Trader A takes 10 trades a month, all A-plus setups that meet every rule in his plan. Trader B takes 40 trades a month because he believes more volume equals more profit. Let's be generous and say half of Trader B's trades are the same A-plus setups Trader A took. The other 20 are B and C grade setups, choppy conditions, forced entries. Those 20 trades have a 45% win rate and 1 to 1 reward to risk. Their expectancy is negative 0.1 R. Trader A's expected return, 10 trades times 0.3 R equals 3 R per month. If he's risking 1% per trade, he's up 3% a month. 36% annualized, compounding. That's life-changing money over 5 years. Trader B's expected return, 20 good trades times 0.3 R equals 6 R. 20 mediocre trades times negative 0.1 R equals negative 2 R. Total, 4 R per month. Sounds better, right? He made more. But wait, transaction costs. 40 trades at $2 each, with a $100 risk per trade. That's $80 in commissions. If his account is $10,000 and he's risking 1% per trade, that's $100 risk per trade. $80 in commissions is 0.8 R. So, his real return is 4R minus 0.8 R, which is 3.2 R. He made 0.2 R more than Trader A. But he took 4 times the emotional damage, 4 times the screen time, 4 times the psychological wear, and he's one bad week away from tilt. And here's the kicker. This math assumes he kept his risk consistent and didn't spiral. In reality, Trader B is the guy who's going to have 3 losing days in a row, get frustrated, and start risking 2% per trade to make it back. Now his expectancy craters and his account implodes. But it gets worse. Let's add in the reality distortion. Trader B is taking 40 trades a month, so he's seeing more volatility in his equity curve. Even with a positive expectancy, his win rate on the full sample is maybe 52% after factoring in the junk trades. That means he's experiencing 18 to 20 losing trades a month. His emotional system is getting hammered. He's questioning his strategy. He's tweaking his rules mid-month. He's in a constant state of doubt. Trader A, taking 10 trades with 60% win rate, is seeing 6 winners and 4 losers. His psychology is stable. His confidence is intact. He trusts his edge because he's only trading when his edge is actually there. This is why professional traders obsess over trade quality, not trade quantity. Paul Tudor Jones has said he doesn't care about being in the market. He cares about being in the market when it matters. Jim Simon's Renaissance Technologies, one of the most successful quantitative funds in history, makes thousands of trades, sure, but every single one is filtered through a statistical model with a verified edge. They're not trading out of boredom. Every retail trader I've ever met who crossed into consistent profitability told me the same thing. I started making money when I started trading less. Not because they got a better strategy, because they stopped volunteering to pay the tax on low-quality setups. Let's talk about what this looks like in the real world. Imagine a surgeon. Every time he operates, there's risk. Risk to the patient, risk of complication, risk of malpractice. Does the best surgeon in the hospital try to do 12 surgeries a day because more surgeries equals more success? No. He does 2, maybe 3. The ones that need to be done, where his skill makes the difference. The rest, he delegates or delays. His edge is in precision, not volume. Now imagine a surgeon who's doing 12 surgeries a day. He's exhausted by surgery 8. He makes a mistake. The patient suffers, his reputation tanks, and his career is over. Trading is surgery on your capital. Every entry is a cut. If you're making 12 cuts a day, you're going to slip. And in trading, when you slip, there's no insurance. You just lose money. Here's the framework. I want you to build a trade filter that has 3 gates. Gate 1, market condition. Is the market in a state where my strategy has a historical edge? Trending, volatile, liquid? If it's shopping, if it's a holiday week, if volatility is dead, you don't trade. Gate 2, setup quality. Does this setup meet every single rule in my plan? Not 80% of the rules. All of them. If you're making excuses, if you're saying, it's close enough, it's not A+, and you don't trade. Gate 3, state check. Am I mentally and emotionally sharp right now? Did I sleep well? Am I calm? Am I trading from clarity or from boredom, revenge, or FOMO? If you're off, you don't trade. 3 gates. If any gate is closed, you don't enter. This filter alone will cut most traders' trade volume by 60 to 70%, and it will double their profitability. Now, let's go deeper. The reason trading less makes you more money isn't just about filtering bad trades. It's about what happens to your psychology when you give yourself permission to do nothing. The market rewards patience in a way that almost nothing else in modern life does. We live in a world that glorifies hustle, grind, constant action, but trading is the opposite. Trading rewards restraint. It rewards the ability to sit in front of a screen for 4 hours and take 0 trades because nothing met your criteria. That's not laziness. That's professionalism. Warren Buffett has said his ideal holding period is forever. But even in his active years, Berkshire Hathaway made maybe 1 or 2 major decisions a year. Not because he couldn't find more opportunities, but because he was waiting for the no-brainer, the pitch right down the middle. He wasn't swinging at every pitch. Most traders are swinging at balls in the dirt because they can't handle the discomfort of waiting. There's a neurological reason for this. Every time you enter a trade, your brain releases dopamine in anticipation of a reward. It feels good. You're engaged, you're alive, you're playing the game. But dopamine isn't triggered by winning. It's triggered by unpredictability. Slot machines are addictive not because they pay out, but because you don't know when they'll pay out. Trading is the same. Every entry is a lever pull. And if you're trading too much, you're not trading, you're gambling. You're chasing the dopamine hit of uncertainty. The professional trader has trained himself to get his dopamine from executing his process perfectly, not from being in a trade. He gets satisfaction from waiting for A-plus setups and saying no to everything else. That's the shift. That's the psychological evolution from amateur to pro. Let me give you a real example. I tracked two traders for 6 months. Both had the same starting capital. Both were trading the same market. Both had similar strategies. Trader X took an average of 43 trades per month. Trader Y took an average of 11 trades per month. After 6 months, Trader X was down 18%. Trader Y was up 42%. When I dug into the data, here's what I found. Trader X's win rate was 48%. Trader Y's win rate was 64%. Trader X's average reward to risk was 1.1 to 1. Trader Y's was 1.6 to 1. Why? Because Trader Y was only trading the best setups. He was waiting for confluence, for momentum, for clarity. Trader X was trading every time he saw a moving average cross. He was active, he was grinding, and he was getting destroyed. Same market, same opportunity set. One trader had the discipline to do nothing most of the time, and he won. The other trader couldn't sit still, and he lost. Here's what I want you to do. For the next 30 days, I want you to cut your trade frequency in half. If you normally take 20 trades a month, take 10. If you take 10, take 5. Force yourself to be more selective. Write down every setup you see that you would have traded before, but mark whether it met all your criteria or just some of them. At the end of the month, compare your equity curve to the previous month. Compare your emotional state. Compare your win rate. I promise you, if you're honest about setup quality, you'll see your profitability increase and your stress decrease. This isn't theory. This is math, and it works every single time. The traders who survive this game long enough to become wealthy aren't the ones who trade the most. They're the ones who've learned that every trade is expensive, that the market is open tomorrow, and that doing nothing is a position. Jesse Livermore said, "The big money is made in the waiting, not the trading." George Soros has talked about how he spends most of his time doing nothing, and then, when he sees a mispricing, he bets big. These aren't people who got rich by staying busy. They got rich by staying patient. You're competing against people who understand this. If you're still trying to outtrade them, you've already lost. Here's your takeaway, and I want you to write this down. Every trade I don't take is a trade I didn't lose. The goal is not to trade more. The goal is to trade better. The goal is to be so selective, so disciplined, so patient, that when you finally do enter, it's because every single factor is aligned in your favor. That's when you press. That's when you risk. The rest of the time, you do nothing. And doing nothing is the hardest, most profitable skill you'll ever learn. If this hit home, drop a comment and tell me how many trades you took last month. Let's see who's over trading and who's already on the path. And if you know a trader who needs to hear this, share it. Because the market doesn't care how busy you are. It only cares if you're right.